Hello and welcome back to the show. Today I have a really good thought-provoking subject to share with you today. The topic of which is house price inflation a con? Let's take a little bit of a deep dive into this subject to share with you what I mean. Now, as a property investor and property coach, I have always been fascinated by house price growth because it's been the mainstay of our business. It's been what we have dedicated the last 23 years to building on the whole. And so I've always had a fascination on this subject. And I've had this fascination from quite a young age, really, because my husband and I bought our first ever flat in 1994. And we bought the flat because it was cheaper to pay the mortgage than it was to pay rent. The mortgage was about £220 a month, and the rent was going to be, for the same type of property, about £450 a month. So it was a no-brainer, and we were encouraged by my parents to just get on the property ladder as young as possible. So we did. And we witnessed that flat go up in value by over double in about 5 years in that day and age. And then we moved over and bought a house. And again, we witnessed that double in value in an even shorter period of time, because that was the late 90s, early 2000s, and the market was just going absolutely potty. So that house doubled in value in around about 2.5 to 3 years, I believe, going back in my memory, which is absolutely astounding. And it was one of the main reasons why we chose to go into property, because we'd experienced such powerful growth in our own properties that we had bought as a home. And we felt that you simply couldn't save at the same rate as a property goes up in value, typically speaking. It's really hard for somebody, even on a decent 5 or 6 figure salary, to, especially in this day and age, to be able to save a pot of money to be able to put down as a deposit on their own home, let alone any buy-to-let properties. And that's what a lot of people, younger people, are experiencing in this day and age, that it's just kind of really out of reach. So I wanted to kind of delve into this subject because it's really important to understand how this has kind of come about, and the fact that we see property prices going up. Is it a bit of an illusion? So yeah, like I say, let's kind of go into this with a bit more detail and see and sort of unravel it a little bit. Okay, so typically, well, what we've experienced is that we've had our nest egg grow more than we could have ever imagined it would grow sitting in the bank in property. So we have witnessed house price inflation work to our massive benefit over the years. However, is this true for most people, or is house price inflation a bit of an illusion, like I'm saying? Now, interestingly, the house price boom, I'm going to say boom in inverted commas, of the last 14 years since the credit crunch is actually quite a lot less impressive than it may seem. The real rate of house price growth has slowed down dramatically in the last 4 years. And the biggest reason for this is the level of inflation that we have seen against house prices. And I shared with you the impact of inflation on the real value of money a few episodes back. It's an episode sort of about navigating economic change. If you want to go back and have a listen into that episode, if you haven't done so already, where I explain that our money has basically been devalued. Our currency has been devalued by the tune of about 20 to 25% over the last 4 years alone. So you can imagine the effect that has had on the market as a whole, including house prices. And also the fact that real wages are a very important factor in determining house prices. Now, when in historical times, back in the 1970s and 80s, where interest rates went through the roof on occasions, At that time, even though that was a nightmare scenario for people who had loans, the fact of the matter was that wages were being put up more in line with that rate of growth in terms of the interest rates and the inflationary situation. So real wages were keeping up more or less with these economic changes overall. Whereas in this day and age, that simply isn't happening. If you look at the house prices to earnings ratios, in this day and age, they are so far apart compared to what they used to be. In my parents' generation, it was probably, the house prices to earnings ratio was more like, sort of 3 to 1, 4 to 1. And in this day and age, it's probably more like 6, 7, 8 to 1, meaning that the amount of times your wage to the average versus the average house price has just, the gap has become more and more and more and more. And the affordability, therefore, is not there like it used to be. Hence why what's called now, it's a term that's been coined, the Bank of Mum and Dad has become one of the largest lenders in the UK. In fact, 57% of all mortgaged first-time borrowers last year used the Bank of Mum and Dad in order to be able to buy their first property. And that's how large it's got. So this is parents who are releasing equity from their own homes or using savings to help their children get onto the property ladder. Because otherwise, they simply, this generation, this latest generation or generations, is finding it harder and harder to actually be able to save to afford their own home. It makes you wonder why in this country we are so fascinated with house prices. It seems to be a hot topic of conversation amongst a lot of people. And the reason for that, interestingly, is that 50% of the UK's wealth, this nation's wealth, is tied up in property versus just 25% in the US, which is really interesting. So that's why we're so fascinated and kind of hung up on house price growth in this country. And also a lot of Europe is, properties over there are rented by the state. They're not owned by you and I. You're not owned necessarily by property investors. More often than not, rental properties are owned by the state, and hence why it's not as big a topic of conversation as it typically seems to be over here in the UK. I'm generalising a little bit, okay? This nation has always been fascinated by how quickly and how impressively house prices have gone up. And the fact that we are an island, we're not building any more land, our population levels are increasing, significantly due to many factors. It's just become quite a little bubble, really. I suppose it's in its own little bubble. But it's interesting to note that it's not as impressive as it may seem, because with recent inflation levels, the real value of housing or house prices is much less impressive. So in real terms, real house prices are still lower, in fact, than they were in 2007. Which is absolutely fascinating. And in actual fact, they're around 12% down on 2022. You can go and look up the statistics for yourself, but that's the long and short of it, is that actually house prices, compared to inflation and all the economic changes that have happened since the credit crunch, they're not worth any more than they were in 2007. So that is a bit of an illusion, isn't it? From around about 1960 to 2007, just before the credit crunch, is actually a real anomaly in terms of significant real rises in house prices. Our parents, my parents and my generation, have been pretty lucky in terms of experiencing real house price growth. But it is at the moment quite hard to see any continued increase in real house price values. I will go into a little bit more detail about what the predictions are in just a minute, but there is one scenario where this does still work for people. And I'm not saying that it's not still worth getting onto the property ladder, because in effect, if you're just leaving your money in the bank or relying on low value or low income producing assets to, park your money, if you like, your money's just going down. With inflation and the way that the economy is going, it's just constantly being eroded. So in my humble opinion, and caveat, this is my humble opinion, I feel that it is still worth parking your money in the right way into the right property, in terms of being able to ride out any economic waves that are going on, because otherwise your money's just going to be, becoming worth less, unfortunately. There is one scenario where this does still work though, and that is if you own more than one property. And more importantly, if that property or those properties are leveraged, meaning that you have money, like a mortgage, taken out against the value of the property. So the deposit that you would put down and the costs that you have to buy, if you were to spread an amount of money over a few different properties, are still much more likely to go up considerably more than if you leave them just sitting in the bank, even if the properties are just going up at the rate of inflation. Okay, so it all depends on how much leverage you have and whether you can leverage that debt comfortably across a certain number of properties. So I'm going to give you an example of this. So in simple terms, if you had £100,000 to work with, for example, and you put that 100,000 into one property and you had no mortgage, and that property was to go up in value, let's call it really conservative, by 20% in 5 years, then that property is going to be worth 120,000 in 5 years' time, meaning that you've made a profit of £20,000, right? Simple. Now, instead, if you had spread your £100,000 across two properties and you owned two £100,000 properties and you took a mortgage out of £50,000 on each property, then that's called being leveraged of 50% loan to value. That's the mortgage against the value of the property. So you put £50,000 down in simple terms, and 50,000 you're raising from the bank to buy the property. And if both of those properties go up 20% in 5 years' time, that means that each property has made £20,000, meaning that you've doubled your profit to £40,000 from the same £100,000. So in one scenario, you're making 20%. In the next scenario, you're making 40% with the same amount of money. And of course, if you take it even further, if you were to spread it across 4 properties, and instead of putting 50% down as a deposit, you only put 25% down and raised a mortgage of 75% against each £100,000 property, then you'd own 4 properties leveraged at 75% loan to value with 25% of your own money into each deal. But instead, when those properties go up over 5 years, 20% each, that means that your total profit is actually £80,000. So you can see here how and why the power of property is still there. This is obviously, caveat, in the respect that properties still go up in value. But the key here is, and this is absolutely fundamental, and what I teach my clients and have been over the last, what are we talking, 15 years now? No, longer. I think it's 17 years that I've been coaching people in property, is that you have to buy correctly and not just rely on the fact that house prices are going to keep going up in value. You have to be able to make the money when you buy, meaning that you have to find a really good, solid proposition that you can either add value to or that you've bought below market value. There are many, many proponents of this in the marketplace, of course, and this is absolutely key. It's absolutely vital that you just don't work on a hope and pray strategy of, I'll buy this property and I'll hope it goes up in value in the next 5 years. No, you have to lock in that profit from the word go. And then when the market ebbs and flows, like it always does, but over the course of time, and in history shows that property prices typically over the course of time double every 7 years, then if you look at the trend, the way that the property prices are going, then being able to leverage comfortably meaning that you're able to maintain and sustain those properties at that level of leverage. That's the key thing, is that you've got enough cash flow to be able to continue to hold those properties at that level. And that's when house price gains can be really advantageous. So that's the scenario where it still works to own property. And even if you're just going to consider buying a property for yourself to live in, the principles of this still remain the same. If you're able to buy a really cracking property in a great area, a great location, which needs some work, and you're able to learn how to negotiate and get money off that deal even before you've moved in, this can still work for you. And that's what I just absolutely love helping people to achieve. With these different scenarios, it's all very different, and it depends on your own level of risk, of course, what you're comfortable with, what you want to achieve. But just know that just because house prices appear to be going up, it's not necessarily real growth. In fact, taking a bit of data off the internet, the Office of National Statistics actually predicts a 4% increase only in property values over the coming years. And in fact, last year they were predicting minus 10%. But, in some areas, this may well have actually happened now, because some properties are just not shifting and they're selling at a lower price point now. Other areas are still remaining quite buoyant, and they're able to sell at prices that have been around for the last 12 to 18 months or so. So it is very much area dependent, and it is very much person dependent as well, as to whether you need to buy or sell a property at any particular time. Interestingly, Savills say that house prices will increase by 28% by 2028. But even if that's the case, the real house price increase will only be 2% per annum because of inflation and affordability. So again, it's really interesting to kind of, get your head around this one, not just to think that just because house prices are going up or down, that you're doing well. You need to lock in that profit from the minute you buy the properties. And of course, with the effective rise on interest rates, which have been a big topic over the last couple of years, particularly those who are coming off fixed rate mortgages since they took them out 3, 4, 5 years ago, the effective rise on mortgage rates actually has typically gone from 2.5% interest rate to about 3.7%. And of course, this will continue to rise as more people have to remortgage onto currently higher rates. And none of us, let's face it, can predict exactly what's going to happen with interest rates. I've been hearing on one camp that they're definitely coming down. Basis points being lowered in the US. We had one rate cut over here, didn't we? Not that long ago. And, but it just still seems like the market is a bit sticky on that front. And yet on the other camp, I've heard that rates are going to go up again. So really, who knows? But again, we can only work with what we've got going on right now at any particular point in time. So that's really important just to bear in mind. Where are you at right now? What works in this current situation if you are considering buying property? I think, again, personally, caveat, this is my take on things, that it would have to take a real, what's called a black swan event, something major to happen, which who knows what's around the corner, right? For something to create a house price crash like we've seen in the past. And I hate to predict, and I don't know what, like I say, none of us know what's around the corner. Of course, there's an awful lot of an economic storm around at the moment. It feels like it's brewing up. And again, listening to all sorts of sides of the equation, it feels like if something major was to happen, then none of us could really do much about it, and house prices would be affected by that. When we went through the credit crunch, and we held quite a lot of properties by that point, when the credit crunch happened back in 2008, most of our equity in our properties was wiped out in one fell swoop, which was pretty scary, because we're thinking, oh my goodness me, because a lot of people went into negative equity at that point, and they couldn't sell even if they wanted to, or if they if they had to sell, they would have lost money, and they would have had to either pay the bank back or just, take it on the chin, become bankrupt, etc., etc. So we were holding our properties, and a lot of the equity was wiped out at that point. However, the one absolute saving grace at that time was the fact that interest rates also went through the floor. So our cash flow ramped up massively. So we really didn't care. It didn't matter that this downturn had happened, because our cash flow was so strong at that point. It didn't matter. It meant that we could hold those properties until the market came back, which it did start to come back fairly gradually to start with, and then it started ramping up more in the following years, from probably around about 2011, 2012, started to really sort of take off again. But what I mean is, it's all about buying carefully, making sure that you're making the right choices at the right times. The government at the moment has promised to build 1.5 million homes in the next 5 years. Personally, I think that is highly unlikely that they'll be able to actually achieve that. Not only due to the fact that the actual funding it would take to do that, but also the power, the manpower, the ability to actually find the tradespeople who will be able to put this into practice and come to fruition. There are fewer and fewer skilled tradespeople now being kind of brought through the education system who would be able to facilitate that. So I just don't know how they're actually going to be able to build that many homes. It's another government promise which I personally don't see coming to fruition. So therefore that still puts upward pressure on the housing market as it is currently. So it's even if they did build 1.5 million homes in the next 5 years, it's still only an increase of 1% of the entire market of properties in the UK. So I just don't see it impacting house prices negatively, shall we say. So some people are worried about the fact that if this comes flooding in and there are a lot more homes being built, will it affect house prices? Will they go down? It's negligible. Like I say, the upward pressure on the housing market, I can't see it having like a massively huge effect, except if we have whatever black swan event that may or may not come along. But you do have to make sure that you're buying correctly. Like I say, the biggest house price potential for house price growth is in the more affordable areas. So if you are considering buying, or you're kind of thinking, well, where can I buy in the UK and still park my money and still have it working for me, it would be in the more affordable areas of the UK. And there are plenty of those around. And it is a question of knowing and understanding what the markets are locally in those places, and understanding regionally which places are performing better than the others, or what factors in those areas are going to keep the market buoyant. And that's why learning and educating yourself and understanding which areas are going to remain strong is really, really important. It is, in my mind, still a fantastic time to get into the market if you know what you are doing. And that is the absolute key. Where you've got fear mongering, where you've got scaremongering, from headlines, the news, and government policies, etc., where people tend to run away because of fear, that's when you can come in strong and say, right, okay, I'm learning and I know what I'm doing, and therefore I can make that best choice. Markets always have ebbs and flows, and it's a matter of understanding the market conditions and buying correctly. So whether you have a few properties under your belt, or you're interested in getting started, whatever stage you're at, and you'd like to know what the best strategies are in the current market right now, and the best locations for you to consider buying property, then I am basically just started to re-offer my one-to-one mentoring and coaching services again. I have been doing this, like I say, for about the last 17 years now, and essentially I love nothing more than helping people to really get this right, because it can make such a huge impact on your lives. I had a bit of a break for about 2.5 to 3 years of mentoring and coaching, and it's been great to step back, but actually what I absolutely discovered was that I really love working with people and I love coaching and mentoring. So having had a bit of a breath, step back, I'm now ready to take on some more one-to-one, but only a very small number. So if you are interested in having some help or some guidance from myself, then please feel free to get in touch with me at the website, in this page, or if you can't find it anywhere, it's the-freedom-club.com. the-freedom-club.com. Feel free to pop me a line and we can have a bit of a chat to see how I might be able to help. In any case, I hope that's been an interesting journey for you, this episode, to understand real house price growth versus inflationary house price growth and the impact that has on your portfolio overall, the property that you own overall. And I look forward to seeing you on the next episode. Bye for now.